Mergers and acquisition in private equity. Understanding the role of M&A in private equity. Presentation overview. Mergers and acquisition. Mergers and acquisition are defined and their benefits and types are explored. Private equity industry. The characteristics of the private equity industry are examined, including the investment process and fund structures. M&A in private equity lifecycle. How M&A fits into the private equity lifecycle is examined, including integration strategies. What are mergers and acquisition? Mergers. Mergers occur when two companies join together to form a new company. This strategic decision is usually made to achieve growth and gain a competitive advantage in the market. Acquisitions. Acquisitions occur when a company takes over another company. This strategic decision is usually made to gain a competitive advantage, acquire new technologies, or expand the market share. Benefits of M&A. Economies of scale. Mergers and acquisition can help companies to achieve economies of scale, which can lead to cost savings and increased profitability. Increased market share. Mergers and acquisitions can help companies to increase their market share, which can lead to increased profitability and competitiveness. Access to new markets and technologies. Mergers and acquisitions can help companies to access new markets and technologies, which can lead to increased innovation and competitiveness. Enhances shareholder value. M&A can help companies enhance shareholder value by increasing profitability and competitiveness. Types of mergers and acquisitions. Horizontal M&A. Horizontal M&A involves the merger or acquisition of companies in the same industry. This type of M&A can lead to synergies by reducing competition and increasing market share. Vertical M&A. Vertical M&A involves the merger or acquisition of companies in different stages of the supply chain. This type of M&A can lead to cost savings and increased efficiency. Conglomerate M&A. Conglomerate M&A refers to the merger or acquisition of companies in unrelated industries. This type of M&A is often driven by diversification and risk reduction strategies. Characteristics of private equity industry. Investment process. The private equity industry involves a thorough investment process, which includes sourcing, screening, due diligence, and negotiation. Fund structures. Private equity funds are structured as limited partnerships, where limited partners provide capital and general partners manage the investments and operations of the fund. Private equity industry overview. Investments in private companies. Private equity firms invest in private companies with the goal of creating value and generating higher returns than public markets. Investment strategy. Private equity firms typically invest in companies that are distressed, underperforming, or undervalued. Operations and profitability. After investing in a company, private equity firms work to improve its operations and profitability. Private equity investment process. Deal sourcing. The first stage of the private equity investment process involves finding potential investment opportunities through various channels, such as industry contacts, market research, and specialized databases. Due diligence. Private equity firms conduct a thorough due diligence process, which involves analyzing the target company's financials, management team, market position, and growth potential to assess the investment's viability. Valuation and negotiation. Based on the due diligence results, a private equity firm will determine the target company's fair market value and initiate negotiations to agree on the investment terms. Post-investment management. Private equity firms take an active role in the management of their portfolio companies with the goal of creating value and achieving a successful exit. This involves working closely with the management team to improve operational efficiency, streamline processes, and drive growth. Private equity fund structures, limited partnerships. Private equity funds are typically structured as limited partnerships, where the fund manager acts as the general partner and the investors act as a limited partner. This structure offers limited liability to the investors. General and limited partners. In a private equity fund, the general partner is responsible for managing the fund and making investment decisions, while the limited partners provide capital and only have a limited say in the fund's operations. The general partner also has unlimited liability for the fund's debts and obligations. Closed-end funds. Private equity funds are usually structured as closed-end funds, which means that they have a fixed term and a specific investment strategy. Investors cannot withdraw their capital during the fund's life cycle. The fund can only invest in opportunities that are in line with its investment strategy. Mergers and acquisition in private equity. Importance of M&A and private equity. Importance of M&A in private equity. Mergers and acquisition are a critical tool in the private equity industry for achieving growth and generating higher returns. They provide opportunities for private equity firms to broaden their portfolio, streamline operations, and improve profitability. Private equity life cycle. M&A is an integral part of the private equity life cycle and allows firms to maximize their returns. It is used to enter new markets, acquire new technologies, and diversify their portfolio. Integration strategies. Integration strategies are critical for the success of M&A deals in private equity. It involves aligning the two companies' cultures, streamlining operations, and building a strong team. Why private equity rely on M&A? Creating value through M&A. Private equity firms rely on M&A to create value by acquiring businesses that can be restructured, optimized, and integrated with existing portfolio companies to create a synergetic relationship. Achieving strategic objectives. M&A provides a means of achieving strategic objectives such as expanding product lines, entering new markets, and diversifying revenue streams. Exit strategy and higher returns. M&A provides an opportunity for private equity firms to exit investments and generate higher returns for investors through strategic sales and IPOs. M&A in private equity lifecycle. M&A in private equity lifecycle. M&A are significant part of private equity investment across the entire investment lifecycle, from deal sourcing and due diligence to post-investment management and exit. Strategic objectives. M&A can be a means of achieving strategic objectives such as expanding into new markets, consolidating market share, or diversifying product lines. M&A integration. Types of integration strategies. M&A integration can involve different types of integration strategies, including full integration, partial integration, and holding company. Full integration involves integrating all aspects of the acquired company's operations into the acquiring company, while partial integration involves integrating certain aspects of the acquired company's operations. Holding company involves keeping the acquired company as a separate entity under the ownership of the acquiring company. Challenges in the integration process. M&A integration can be a complex and challenging process with various challenges that can arise. These include cultural differences, communication problems, resistance to change, and operational issues. Conclusion. Mergers and acquisition basics. Mergers and acquisition are an important part of the private equity industry, creating value and generating higher returns. Understanding the basics of M&A is essential for success in this field. Characteristics of private equity industry. Private equity industry is a growth-oriented industry, and understanding its characteristics like timing, deal structure, and financing and exit strategies are essential for success in this field. Thank you.